The past year has been rough for some of Canada's blue chip giants. Five in particular have stumbled hard. But are they lost causes or, well, perhaps they're once in a decade buying opportunities hiding in plain sight? Fasten your seatbelts, folks. This is going to be a bad one. When it comes to blue chip stocks, usually safety, stability, and steady returns is what comes to mind. And, well, for good reason. This is what historically has been the case. These stocks are the titans of the market, household names that they anchor countless Canadian portfolios. However, they are not immune to taking a stumble. And over the last year, some of them, they've more than stumbled, they've tripped rather hard. We are going to be looking at five of the worst performing blue chip stocks on the TSX in the last year. These companies come with name recognition, big market caps, and maybe, for some of them, opportunities to average down. So what happened? Why did they fall so far? And is there a chance they could fall even further? With a tariff-fueled possible recession on the horizon, that is a real possibility for sure. Another important question is, do any of these battered stocks represent an opportunity in disguise? Are they indeed value traps, or could they be on sale for the smart investor who's ready to hold them through the coming economic storm? We are going to look at what went wrong as well as how each company might fare in a looming recession. In addition to that, we're going to figure out whether they deserve a spot on your watch list or perhaps they should be on your blacklist. A sub to the channel is your watch list for future content. For today's list, there was two qualifiers. First, you needed to have a market cap of at least 10 billion. And in addition to that, the company needs to have had a really bad year. No worries, there were plenty of companies to choose from. Today's list is sorted by their one-year total return, but going in the opposite way from high to low. So without any further ado, let's do this. Coming in at number 5, we've got Canadian National Railway, ticker of CNR. Oh boy, with the year CN has had, it is not surprising to see them kicking off this list for sure. They had a rough year with labor disruptions, wildfires, other interruptions from adverse weather conditions. Holy banana bread. They had everything but the kitchen sink thrown at them. At the time of recording, their price is coming in at $139.97. They got a market cap of $87.83 billion, and their beta 0.88. So that is less volatile than the market average. And that's one of the reasons that this is a recession-proof stock. Their earnings per share coming in at 7.14, and they have a price-to-earnings ratio of 16.60. That return on equity, I like this number, 21.73%. Return on assets, 7.72%. Their debt-to-equity ratio, 98.31%. Looking at their dividend, they have a yield of 2.536%. It is a quarterly dividend of 88.7 cents per share. Payout ratio on that, 47.93%. When it comes to their returns, this is where we're going to start seeing where things started to go wrong. The 3-year return on investment, negative 3.22%. So it's not that bad, but trust me, it gets worse. Total return after we add in the dividends on the 3-year, 3.54%. Looking at their 1-year return on investment, negative 19.67%. Add in the dividends, total return, negative 17.68%. Their 3-year annualized is in the positive 1.17%. While facing short-term challenges, CN's long-term fundamentals, they do remain very solid. And this does make them a very good potential hold or buy for those patient investors. I am a fan of this stock, and this is one that, for me, I'm certainly going to buy while they're down. Coming in our 4th spot, we have Magna International Incorporated with a ticker of MG. This here, of course, is our auto parts supplier. So with a global decline in light vehicle production, Magna, they've been off to a rough start in 2025 for sure. They have seen a drop in sales of about 8%, and unfortunately, that could just be the beginning. Oh boy, those bloody tariffs. At the time of recording, their price is coming in at $48.51. They got a market cap of 13.67 billion. Their beta 1.68 and their earnings per share coming in at 5.55. Their price to earnings ratio 8.74 and that return on equity 10.15%, return on assets 3.89%. Their debt to equity ratio is not too bad, 62.12%. Looking at their dividend, they have a yield of 5.508%, quarterly dividend of 48.5 cents USD per share. Payout ratio on that, 47.63%. Looking at their return on investment, oh boy, 3-year, negative 38.50%. Factor in those dividends, total return, negative 28.92%. On the 1 year, that return on investment, negative 24.34%. Adding in the dividends, we do get a total return of negative 20.20%. Your 3-year annualized deep in the negative as well, negative 10.75%. The auto industry is cyclical in nature, but with auto tariffs and a possible recession, the next year, well, it could be as rough as last year. Oh boy. I see this one as more of an approach with caution investment for sure. Coming in at number 3, oh boy, we got BCE Incorporated. So Bell, we got Bell. Their ticker, of course, BCE. Oh, good old Bell. They have not had a great year. In fact, their stock fell consistently in line with their falling revenue, which was of course impacted by a whole bunch of different things, including regulatory changes as well as the costs that they have had to expend on that 5G rollout. In addition to that, oh boy, they just had a huge, slightly more than 50% dividend cut. On the bright side, that dividend cut was absolutely needed. So we'll see how they respond. Initially, they did start going up a little bit. So maybe there is some hope, but oh boy. At the time of recording, their price coming in at $31.60. They got a market cap of 29.13 billion. Their beta 0.67, so they're not that volatile. Earnings per share 0.42. Their price to earnings ratio a little on the high side, 75.24. That return on equity 3.16%. That's low. And that return on assets, look at this. You don't see the return on assets being bigger than the return on equity that often, but in this case, they are 4.84%. Their debt to equity ratio, 222.44%. Looking at their dividend, they have a yield of 5.538%, quarterly dividend of, well, now it's 43.8 cents per share. Payout ratio on that, 950%. Now, right away, I would take that ratio with a grain of salt, as we will need to see where it settles next quarter because of that cut. I don't think that ratio is taking that cut into consideration yet. On their 3-year return on investment, yikes, negative 53.48%. Add in the dividends, total return, negative 37.08%. On their 1-year return on investment, negative 32.19%. Add in those dividends, total return, oh boy, negative 24.82%. 3-year annualized, this is not good either, negative 14.31%. Telecommunication services are, well, they're generally considered essential, providing some resilience during economic downturns. However, discretionary spending cuts by consumers could absolutely affect some of their premium services and advertising revenues. As a result, this is one that I do think we need to look at with some caution, for sure. All right, sticking to that same industry at number 2, we've got Rogers Communications Incorporated, RCI.A being the ticker. Rogers' dismal performance can be attributed to intense market competition, declining cable revenues, that's hurting them big time, and of course, macroeconomic uncertainties. In addition to that, they have added a lot more debt thanks to the purchase of Shaw Communications. And that is still affecting their overall cash flow. So at the time of recording, their price coming in at $39.60, and they got a market cap of 19.44 billion. That beta 0.83, earnings per share 3.24, and their price to earnings ratio 12.22. That return on equity 16.56%. Return on assets, 4.41%. Now, and this is where that shock part comes in, that debt to equity ratio, and this is where you see the influence of that Shaw purchase, 464.36%. Looking at their dividend, they have a yield of 5.051%, quarterly dividend of 50 cents per share, payout ratio on that 61.73%. This is a lot healthier than Bell, that's for sure. Looking at that 3-year return on investment, negative 40.79%. Add in the dividends, total return, negative 31.82%. On their 1-year return on investment, negative 32.86%. Adding in the dividends once again, total return, negative 29.47%. 3-year annualized on this, negative 11.99%. As with BCE, Rogers provides essential services, but economic downturns could, of course, impact consumer spending and those advertising revenues. Given the current challenges, investors absolutely should be cautious. Though the company's essential services, they may offer some stability for Rogers. Okay, in our top spot at number one, and this is not nothing to brag about for sure. We've got Synovus Energy Incorporated, ticker CVE. Oil has not had a great year. And Synovus has, well, they followed that suit. They have had to battle against lower oil prices as well as that overall economic uncertainty. So, not a great year for sure. At the time of recording, their price coming in at $18.45. They got a market cap of $33.64 billion. That beta, 1.28. Earnings per share, 1.67, and their price to earnings ratio, 11.05. That return on equity, 10.75%. Return on assets, 5.41%. Their debt to equity ratio, and I'm liking this, 35.72%. Looking at their dividend, they have a yield of 4.336%, quarterly dividend of 20 cents per share. Their payout ratio coming in at 48.80%. Looking at their returns, their 3-year return on investment, negative 33.68%. Factor in those dividends, total return, negative 27.23%. On their 1-year return on investment, negative 33.61%. Adding in the dividends, total return, negative 30.95%. 3-year annualized, negative 10.05%. A global economic slowdown could reduce demand for oil, affecting Synovus's revenues for sure. However, they do have some pretty good integrated operations, and they're looking at cost-cutting measures that may help mitigate some of the impacts. While facing sector volatility, Synovus's strong infrastructure and dividend yield they do make it a potential hold or buy for investors. So I've got a little bit of hope. I got some hope for this one for sure. These were a good mix of companies for sure. And when it boils down to which of these are good opportunities, a few of the fundamentals came to the forefront. Well, return of equity and debt to equity, to name a couple. CNR and Rogers both had great return on equities. However, Rogers came with a lot of debt. In terms of debt to equity, Synovus, Magna, and CN were under 100%. Of the 5 companies based on that, as well as the current geopolitical situation, I would rank both CN and Synovus as the safe bets to hold and even add to. Rogers could actually go either way. It's the debt has me concerned, but if they get that under control, they should be fine. Bell is still worrisome for now, and of course Magna, well, they could be in for a rough year, especially if those auto tariffs persist. If you are interested in any of these stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on TD Bank, and I will see you in the next video.